It is a case-by-case basis.
Yeah.
You really need to look at what you're earning today and what your anticipated expenses are in retirement, especially if you are like right on the cusp of retirement. It gets muddier and muddier the further you are out from retirement.
Peter, so good to see you. Welcome back, everyone. Let's dive into those headlines, Peter. High earners age 50 plus are about to lose a major 401k tax break. So starting next year, workers age 50 and older who earn more than $145,000 will lose a key tax break for their retirement savings. So what's new here?
So if you are 50 or above, you have the ability to save more to sort of supercharge your retirement savings in the home stretch of your career through catch-up contributions. So the limit for your 401k, if you are 49 or younger, is $23,500 in 2025 this year. If you're 50 or above, you could put in an extra $7,500, a total of $31,000. You can make a lot of headway and a lot of progress doing that. And if you are 60 to 63, there's even an additional supplement above that. You could get in $11,250. But starting next year in 2026, those catch-up contributions must be made on the Roth side of the 401k. And this is just one of the reasons why more and more 401ks are offering the Roth. Now it's almost a requirement here. And so there's a lot that goes into this, but starting next year, if you are 50 and above and you are making those catch-up contributions, those catch-up contributions automatically mandated by law and requirement will be Roth contributions. And so there's a whole lot of kind of ancillary impacts of this that I think we're going to discuss.
Yes. Okay. So again, just to say it again, so before workers could reduce their taxable income with those pre-tax catch-up contributions. So how will this switch to after-tax Roth contributions impact take-home pay and future withdrawals?
Yeah, well, you won't get the deduction any longer. And so there's a couple places where this might be particularly impactful. I don't think that $7,500 of additional taxable income is going to like make or break anybody who's making over $145,000, but you won't get that deduction any longer because, again, these dollars, catch-up dollars, are now going in on the Roth side. Now, where there's pain today, there's benefit in the future is that potentially that is going to be a good thing because later on down the road, those withdrawals will be tax-free. That's not the potential part, but potentially it's going to be a good thing. The reason I say potentially is because if we are dealing with a high income earner today, and then they retire and they are only withdrawing enough to cover expenses, perhaps the traditional thinking of taxes will be lower in retirement could be the truth. And we don't see this across the board. Tax rates have come down over the last 30 years. In fact, we're in a historically low tax environment, as you can reference that chart there. However, for many people who are higher income earners, they're earning more today than what their income is going to require they withdraw in retirement. So deferring taxes may have been a benefit. However, now that those catch-up dollars are going in on the Roth side, they don't get the deduction today, but it will be tax-free in retirement. And again, potentially a benefit, but potentially not if we are in a lower tax environment into retirement. And also don't forget that Medicare looks back 2 years at your taxable income. So if you are on the threshold of that IRMA, increasing your Medicare premiums at 63 and 64 as you are getting right up to that age or above, then this could, I mean, this is a very, very kind of slim number of people this probably impacts, but that difference of $7,500 could put you over that threshold where Medicare premiums are more expensive. And as a result, and in that case, we may want to look at some alternatives here, and certainly to your point, take advantage of maybe some other potential tax deductions we could get.
Yeah, and we'll get into that in a second. But I do want to, I mean, this comes back to our almost literal $1 million question, Peter, right? How do we determine if in the moment we should be contributing to a tax deferred or a tax free account?
It is a case by case basis.
Yeah.
You really need to look at what you're earning today and what your anticipated expenses are in retirement, especially if you are like right on the cusp of retirement. It gets muddier and muddier the further you are out from retirement, because we don't know what tax rates and brackets might be. I know the one big beautiful bill made the current tax rates permanent, but that's in air quotes there because it's only permanent until they come back around and change it again. And there are a couple things within the one big beautiful bill that are going to strongly incentivize them to come back and change these again. And spending also is going to be that incentive. But if we are on the cusp, within 5 to 10 years of retirement, we can hopefully pretty accurately predict where taxes are going to be, at least in the near future. And we really need to take a look at, well, what are my taxes today due to my higher earnings? Remember, that's the group that we're talking about here, earning over 145,000. And then what are my actual expenses going to be in retirement? And if those actual expenses keep us in or around the same tax rate, then we may get a benefit from doing the Roth. But if our taxes and expenses kind of indicate to us, if our spending and expenses rather indicate to us that we might be paying lower taxes in retirement, then maybe there's that benefit for doing those tax deferred contributions, which you can do with the regular amount, right? Up to that 23,000. It's only the catch-up contributions that we're talking about here. So again, it may not be a big deal for many.
All right. So now let's talk through how to make up for that lost deduction. Would you recommend any strategies like Roth conversions, HSAs, or other tax advantaged accounts?
Well, Roth conversions are going to add more tax on top of it. So we got to consider that. But yeah, if we've got the ability for those HSA contributions or charitable giving and gifting, anything that if we are going to, because of these catch-up contributions, move over a bracket threshold, especially the IRMA threshold, and that's going to impact our healthcare and Medicare expenses. And we have the option, on the other hand, for some deductions, then yeah, we need to look at those carefully. But like putting money in one pocket and taking it out of the other is a net wash. It might not make sense. So we just need to look at where your income falls. And if it does push you over a bracket threshold and you can get under it with deductions on the other hand, or maybe it just doesn't make sense to do those catch-up contributions as much as we want to get more money in retirement accounts, maybe it makes sense non-taxable, non-retirement, non-qualified savings, but you're going to pay tax on that just like you would the Roth catch-up contributions, which are now required. So yeah, the IRS is pretty well versed in the tax code. Like they know it and understand it, right? And so there's really not getting around a lot of the things that they require, or the rules that they put in place. They put them in place for a reason, understanding what these tax implications are going to be. And we've just got to look at your situation and then make the judgment in long-term tax planning. What is the best move for you, each as a unique individual? There's kind of no blanket statement there.
Nope. As much as we wish there were, there is no cookie cutter answer here. So Peter, if somebody does want to determine what's best for them in that moment, if they're trying to catch up for retirement, what's the best way to reach you?
Yeah, give me a call at Richon Planning, 919-300-5886, 919-300-5886. And these are kind of the nuances of the tax code that make planning a little bit more complicated, right? And tax planning specifically is one area that a lot of people don't understand or overlook a lot of these nuances that have impacts on them later. So it is one of the 5 pillars, critical pillars to address for a comprehensive plan. And we call that the optimized retirement plan. It's what we put together for our clients at Richon Planning. And if you'd like your optimized retirement plan, looking at income generation, investment management, tax planning, healthcare planning, legacy planning, do give me a call. That is a courtesy complimentary service that we offer to put together your optimized retirement plan. 919-300-5886. 5886, 919-300-5886. And you can also schedule a time for a talk on the website. It looks like richonplanning.com, richonplanning.com. And there's some great downloadable guides there as well.
Right.
Lots of resources at richonplanning.com.
Great. Peter, thank you so much for your time today. I really appreciate it.
Thank you, Erin. As always, great conversation. Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. You know, one of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred, 401k or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings and see what your tax bill is likely to be if you default and defer to the IRS's plan versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.